Hello and welcome. I'm Jackie Stennett, a U.S. Army veteran and the Vice President of Academy Women. Thank you all for taking time to join us for today's event. Academy Women's Career Coaching Workshop, which is held as an annual event, will continue to extend its reach by bringing you a monthly webinar series. As with our annual career workshop, which will be held in 2025 on April 2nd as a hybrid event with options to attend in person or virtually, the monthly webinar series will provide insights from subject matter experts and thought leaders who share their knowledge on a broad array of topics designed to support the professional and personal development of military leaders. For those who are in or considering a career transition, be sure to visit our virtual engagement center. The Virtual Engagement Center is a 24/7 always-on platform where members of the military community can gain access to important resources and connect through asynchronous text, audio, and video chats with top-tier military-friendly employers. While in the Virtual Engagement Center, be sure to learn more about our upcoming events like the inaugural 2024 Service Academy's Global Entrepreneur Summit taking place on October 15th through the 17th in the DC metro area. The Sages will feature over 30 distinguished speakers who will share invaluable insights for achieving success in your business ventures. If you are a graduate or a guest of the 5 U.S. military service academies, there are fast approaching deadlines. To participate in the pitch competition, you must apply no later than tomorrow, October 4th, and registration for the event will close on October 8th. Also, be sure not to miss our upcoming Distinguished Speaker Series being held as a hybrid event on December 6th in Reston, Virginia. The DSS is open to all who are interested, so plan to join us as we take a deep dive to explore AI's impact on the future of work and what leaders must do to adapt to effectively navigate the rapidly evolving landscape of artificial intelligence. In-person seats will be limited, so be sure to register today. And now, we are pleased to welcome Crown Capital as our presenting partner for today's webinar. Our thanks to Lupei Chou and Tiffany Spann for making time to join us to share their incredible journeys and lesson learned from buying their first rental property to managing a real estate portfolio of over 700 multifamily units valued in excess of $10 million in just 5 years. You'll meet the Crown Capital team shortly, but first, I'd like to introduce Susan Phelan, who will be your host today. Susan is a U.S. Air Force veteran, a graduate of the U.S. Air Force Academy, and is the founder and president of Academy Women. We've got a lot to cover today, so let's get started. Please join me in welcoming Susan to the virtual stage. Enjoy the discussion, everyone. Susan, over to you.
Thank you, Jackie, for kicking things off for today. We have a great treat for you as we will be featuring 2 amazing leaders from Crown Capital. I would like to share this disclaimer with you that the opinions and ideas expressed in this webinar are those of the presenters. They do not reflect the opinions or views of Academy Women or its members. All right, now that we are through with some of the house cleaning, I wanted to let you know that you can go ahead and ask questions through the chat or the Q&A feature. We will be recording this session and make it available to you afterwards on our website so that you can review or share it with folks who may not have been able to make it today. I'd like to introduce formally our 2 speakers. We have Lupei Chou, who is a retired Navy commander. She is also the Partner and Investor Relations Director for Crown Capital. And then her partner in crime, Tiffany Spann, who is a co-founder and partner of Crown Capital. And I think you're all going to love hearing from these ladies. They have some amazing information to share. And without further ado, I am going to pass it over to you.
Tiffany and we are business partners and friends, of course. Together we do real estate. And like Susan mentioned, I recently retired, very recent, September 1st, retired from the Navy after 23 years of service. And I know a lot of times people don't really consider entrepreneurship as one of the immediate options post-military. So this is just our story. We want to share with you what we have done, and maybe that's something you would consider. I I know this is a wonderful and powerful group of women. So before we start, I want to tell you this is the one of our favorite quote between Tiffany and I. A girl should be two things: who and what she wants. So remember that, ladies. That's you. Um, a little bit about myself. I So on the top left, you see those are my grandparents. They immigrated to America in the 1980s, which opened the door for my parents and me and my brother to come here. I came to this country at age 18 and joined the military at age 19. And I just finished 23 years, as I mentioned. So it's been really a great journey for me. Everything I have and everything I know, I own it to the military. My husband is also an active duty service member. He will also retire this year at the end of the year after 38 years of service. And I have a lot of respect for him for stick around for 38 years. I also just want to show you some pictures throughout my military service, Navy type, did a deployment in Afghanistan, as you can see there. And also on the left, bottom picture, that is my husband and what I called my two bonus daughters. That's Victoria and Amanda. It is wonderful to have these young ladies in my life because they really make things fun and exciting, and they are great big sister to our son, Alexander. I had Alexander really late in life and in my career. He was born last year, which is, I know a lot of the, is another issue I know it's been talked about a lot in military, is like how you balance motherhood, childbearing, and the career. So that's a topic for another day, but I also have a story to tell there. So that is a little bit about me, and here's Tiffany.
Hi, everyone. I'm Tiffany Spann. I am extremely excited to share my journey with you all today. I come from very humble beginnings with a family that taught me the value of hard work and perseverance, excuse me. And here's just a glimpse into my life. Top left are my parents. Both were blue collar factory workers. Beside that picture is a picture of our family picture from 30 plus years ago with myself and four siblings and parents. After I left a small town, Virginia, I ended up going to the University of Maryland, where I had no clue what I wanted to be, changed majors several different times, and kind of blew with the wind because I wasn't really sure what life had in store for me, or what I really wanted out of life. And after school, I actually ended up going into IT, started my career in IT, migrated over to cybersecurity, really loved it. So I started my own small boutique cybersecurity consulting firm where I've had contracts with the federal government. I also have a 11-year-old son and dog, which have definitely been my inspiration, and why have a few pictures of them along with my sister and her daughter. These are the folks that definitely keep me going on the day-to-day. You'll notice beside the picture of my sister, myself, and niece and son, there's also a few other pictures. These are networking events. If I'm not spending time with my family, I'm typically on a webinar like this, or I'm at some sort of real estate networking event, because it's really what also just kind of keeps me going. I found a passion for it once I started investing. And once I met my partners, Lupei and Noel, which you see the picture of us there, it really helped to magnify my experience and my journey, and really help us to build our portfolio to around $90 million.
All right. So before we start talking about the $90 million, we want to share like how we started. So this is me at the beginning of my real estate career, 2018, 2019 timeframe. And I invested in Indianapolis. Why Indianapolis, you ask? Because the houses are cheap, and that's where it's one of the cash flow markets, meaning that the rent payment usually exceeds the ratio. It's you get higher ratio in terms of like your rent to your mortgage payment expenses. So we call that cash flow market. So that's where I started. I was able to buy these properties for relatively affordable prices, especially I guess 5-6 years ago. So these are the first group of homes I invested, and I'm actually in the process of selling this my entire portfolio to move the fund into our new project. And as we go through this presentation, we're gonna explain as to why we changed our strategy and the reasons behind it.
And this is where I got started in Baltimore, Maryland. Why Baltimore? I live in Bowie, and I also got started around 2018, 2019, like Lupe. I just felt more comfortable investing in my backyard. It's something that I felt like if I set eyes on the property or I could see what was going on, everything was going to be okay. So the thought of actually investing remotely was something that I wasn't as comfortable and confident in as Lupe was. So I started in Baltimore. And here's where I started with 6 doors here, and I still have 3 single families left, which I'm actually going to be selling off within the next year myself. But once I transitioned into multifamily, I started selling off my portfolio, and now I just have a few more left that I plan on selling. So I want to talk to you a bit about my journey. This is actually a picture from one of my rehabs I did in Baltimore, and I want to kind of talk through how the journey went and why we decided to pivot. So when I first started investing, I wore a lot of different hats. These are pictures, actual pictures from my renovations. And let me just back up a bit and let you know, I was actually still working full time with contracts. And so I actually would have to set up shop somewhere in these rentals with my hotspot to work throughout the day. So my day started off dropping my son off at school and then heading to Baltimore to tend to my properties. So I was the general contractor. And when I say general contractor, I was literally pulling the building permits and subbing out the work to some of the workers you may see in some of the pictures that I have up here. I was there when it was inspection day, when it was, framing, whatever the day was, I was on site and there and fully present. I was also the property manager. That's actually a picture of my son on our way up to Baltimore. I had some for rent signs printed out. So we were so excited to put those in front of some of my rehabs and start to market the property. So I was literally the maintenance coordinator, the bookkeeper, the marketing specialist. I had a little helper for a little while until he got tired of it. And on top of being the general contractor and the property manager, I was also the mortgage broker. So when it was time to get funding for these properties, I was the one shopping the loan. When it was time to get my refinances on the properties, I was the one shopping the loan. I was doing all of the legwork. I was also the financial planner, so I underwrote each of these properties. I did all the projections and pro formas. I was the legal advisor to myself, and I also was the leasing agent. So I put together the leases. I basically, as I went along, I was course correcting and figuring it out. And needless to say, I felt like that little emoji there on the slide. I was beginning to be a bit frustrated and wondering why people love real estate so much, because at this point, I was feeling a bit overwhelmed. And so during this time, I also had an incident occur at one of my properties. So I was really in the thick of things, rehabbing properties. I was buying at this time, perhaps like a property every quarter or so. And so the picture in the background there is actually a picture of one of the homes that I had in which a tenant had moved out. So, I mean, you can kind of see some of the items she left and some of the damage in that picture there. But let's jump on into the Cliffmont story. All right, so this is Cliffmont Avenue. When I saw this house, I thought it was a total beauty. I thought it was the perfect rental property. When I bought the property, it wasn't too much work that was needed. We finished off the basement, rehab some bathrooms, paint. I mean, it was a pretty easy rehab. I didn't have to do much to get this one up and rolling as a rental. So 12 months later, this is how it went. So after I had the first tenant, she moved out and did not let me know, and left everything, even a baby grand piano. Everything was in the refrigerator. The cabinets were fully stocked with food. Everything from like the toothbrushes that her and her kids used were still there. So these are actual pictures of the home, how it looked when she had left. So I wanted to break down the numbers for you so you can see how they look on the single family side and for this particular property. So I purchased this property for $74,000. The down payment was 10% at $7,400. Closing cost was around $3,000. The profit for the first year was around $3,500 after expenses. To clean the property out after she moved out was actually $1,000 because she had left around a little over 2 tons worth of stuff. And then the holding costs from when she moved out, and when I say holding costs, I mean the mortgage still had to be paid, the lights still had to be paid, water. So those holding costs are around $1,150. So after around a year, my total out-of-pocket costs were $9,050. And so I was in the middle of rehabs, as I mentioned, and there seemed to be something that just was cropping up on every single property, whether it was a small plumbing issue or whether it was a move out like this. It just really made me think, what should I do? And so I had 2 options, which I have here. Scenario 1, keep the property, or scenario 2, sell the property. So here are the numbers for the 2. So had I decided to keep the property, there would be a total loss of $12,250 because it was around another, I believe, $3,000 or so to actually get the property back in rental condition. So if I kept the property, it would take around 2 years and 11 months to break even. Had I sold the property, I would make a profit of $27,950. And this is taking the property to auction, because when you sell a property at auction, it's a lot cheaper than selling a property through a real estate agent. And it's also a quicker process. So I knew that if I decided to sell, I would go to auction. Because the numbers just wouldn't make sense if I had to pay for the agent fees and pay for the closing costs and everything like that, because at the auction, the buyer pretty much pays for everything. And so with these 2 scenarios in mind, and with everything else I had going on, I'm sure you ladies could probably guess what I decided to do. I decided to sell and take the profit. it was too much at the time. The numbers just weren't exactly making sense. And knowing that I'd have to wait almost 3 years to just regain $12,250, I needed a better way.
Okay.
And so this is when I had my aha moment. I just knew something had to give. And this is what really hit home for me. I wanted to be financially free. I wasn't doing this just to do it, even though I love real estate and it's a passion. I was doing this so I could be financially free, so I could spend more time with my family, and so that I could do the things that I really enjoyed. I didn't want to be a slave to real estate. So I started really thinking about things like, what did it take for me to be financially free? And I started looking at the properties that I had and just running the numbers. And at the time, my average rental profit per door was $200. And so I was also looking at my bills, looking at how much we'd been spending on family vacations. I mean, everything. And so I knew financial security would be $12,500 a month for me. And that's so that I could pay all my bills, pay for school for my son, just all the necessities that I needed. It would be around $12,500. And so as I started to calculate how many homes it would be, which anyone out there know how many houses I would need to be at the financial security phase, feel free to drop it in the chat. So when I saw the number of houses I would need, I was like, oh no, like it's already too much. And I have 6 doors. I can't imagine having 63 doors to get to financial security. And so it was in that moment, I knew I had to change my strategy. And so oddly enough, I didn't even know Lupei at the time, but she was going through a very similar situation. She didn't have a tenant leave her with everything in the house, but she was feeling the same growing pains that I was feeling on the single family side. And that's when we decided to make the pivot to multifamily. And so here's our journey to $90 million. You can see in 2018, 3 doors, 2019, 6 doors. So we were really trying it. In 2020, that's when, we started discovering multifamily a little bit and picked up 24 doors, which were 2.1 million. But in 2021, that's when we came together with Crown Capital, and that's where the magic happened. So you can see from 2021 to 2024, we were able to exponentially grow, and we were able to do so because of the partnerships formed in Crown Capital. And so this is what our multifamily portfolio is comprised of. You'll notice in 2020, this one's actually been sold here. Top left, that was the first property there in 2021. And in 2020, it was actually in Miami. In 2021, there's 134 units in Houston. 2022, we picked up actually a portfolio of properties, a 64 unit in Louisville, Kentucky, and a 92 unit in Lubbock, Texas. And then in 2023 and 2024, we picked up 292 units in 2023 in Houston, and then in 2024, 148 units in Houston. So you'll notice that we decided on different locations, and there's definitely reasoning behind the different locations that we chose, which we'll touch on a little later. But you can see the progression of our portfolio through the years, and I can attest to it definitely being the partnership and really joining forces and focusing on scaling. All right, so our vehicle to 90 million is a real estate syndication. And so we've been able to gain so much traction through utilizing syndications. And so a real estate syndication is when a group of investors come together and pool their money to purchase a property that they wouldn't have they wouldn't be able to purchase on their own. And so there's two types of partnerships in a real estate syndication. You have active partners, they're known as your general partners, and then you also have passive partners. So when you're a general partner, you are planning and supervising the progress, you are raising the capital, getting the funding, managing the day-to-day, and really looking over the asset. As the passive partner, you're contributing to the bulk of the capital needed to close on the property, and you receive equity and dividends. And the active partner also receives equity and fees because they're actually working for the passive investors. And Lupe and I are actually in the active role. And so we have been able to raise capital in order to close those properties, because prior to syndications, we were coming out of pocket with our own capital and hoping that when we refinance, we receive some of the capital back. But through real estate syndications, it's allowed us to actually partner with passive investors to buy larger properties. That's been a win-win situation for both of us.
So I'm going to now talk about some of the benefits of investing in real estate and why we love it. So we're gonna do this in two parts. First is general real estate, right? So as long as you buy real estate, you can buy a single family home, you may buy a strip mall, office building, any kind of real estate, you will get this kind of benefits right here. So on this list here are the things benefits real estate investor gets, right? First, diversification. So what do we mean by that is, so typically all of our investment is default to the market. And what I mean by that is, I'm pretty sure everybody in the audience got some type of retirement plan or stock portfolio, either through your employer, through your own brokerage account. So everybody, that is the most common and the most the type of investment that everybody does, right? Anywhere from your child's 429 to retirement account. So all that stuff is stock market product. So sometimes we talk about, oh, diversify your portfolio. Let's put aggressive type of fund or aggressive stock versus less aggressive. But at the end of the day, it's still a market product, right? So when you invest in real estate, it allows you to go into a whole nother asset class. And this is real estate, along with other things, are classified as alternative investments, which means investments away from the stock market. So, because that is the mainstream. So because the default is the stock market, real estate provides that diversity to your to your portfolio. Tax benefits, there are many ways you can get tax benefits through real estate investing. Anything related to your property operation, management, maintenance, right? Such as mortgage interest, insurance, any fees that you pay to a property manager, any repairs you have to do to your property, all that is tax deductible. Additionally, if you set up an LLC, if you run it as a business, then you get to write off, say, mileage, office expenses, tax, legal, consultation fee, all that stuff, right, as a business expenses. So there are a lot of tax benefit when it comes to real estate, but the biggest one is going to be a depreciation. No any other investment give you depreciation the same way real estate does. A lot of people, especially I know a number of people, if they make good money at their job, if they're high paying employee, W2 employees, And a lot of times people want to put their money into real estate just so they can get that depreciation to help offset their tax responsibilities. Leverage. So what we mean by leverage is whenever you can put a small amount of money to get something when somebody else is funding the majority part of it, right? So for example, Tiffany mentioned that she put down 10% down payment on her rental property. If you're buying a home using VA loan, you can potentially do a 0%. Even at a height of like 20-25% for commercial or rental property, you are still very leveraged because the bank is paying that 65-70% of the price tag, right? I mean, you have to pay the bank back every month through mortgage, but you are leveraged. So this allows you to buy a bigger thing with small money. That's what we mean by leverage. Of course, you know about the appreciation in real estate. And another thing is inflation hedge. What this means is that the property value and the rent go up with inflation. So the opposite would be you have your money in the savings account, right? And then it's losing value every year because it's not being invested and it's not keeping up with inflation. Whereas real estate, for the most part, it is inflation hedge because the value or the rent goes up with the inflation. And of course, the passive income coming in as rental income. Now, there are certain things that's specific to commercial real estate, and we're going to talk about the difference between residential and commercial. So one of the idea, in here, in this idea really is bigger is better, as Tiffany kind of touched on already. The struggle as a property owner or as if you own a rental property as a property manager, as when you deal with tenants, maintenance issues. So when we buy a large property like the one you saw in the picture, we are able to hire professionals and we are able to get a high quality asset versus the type of property I used to buy in Indianapolis, which are older and not in the best neighborhoods and require a lot of work. Of course, there's the economy of scale. So say if you own 10 houses, right? And then they are individual houses, they are all located in different places. Whereas having a building with 10 units under one roof, it allows you to manage a lot more effectively and have a greater efficiency on everything, on the income side, on the expense side, on management side. So this is something residential is not really able to offer when it comes to scale and have this kind of operation. And another really important factor, I would say this is probably the most important factor, is valuation. The way residential property and commercial property are valued are different. And we're going to do a little exercise so you can see how the math work. So the formula, it's called the cap rate formula, if you heard of it. But if not, we're going to walk through this really quickly at a very high level. Just you can see the difference, the change in numbers. But basically, as everybody probably know this, right? A residential property, so that means anything under 4 units. So you can have a 2 units, 3 up to 4. It's still considered residential. And if you don't know this, you can actually use your VA loan to buy a residential property up to 4 units and living in one and make the rest a rental. And the VA would actually fund it. But the valuation, so anything that's residential, the value is based on comps, market comparables. So the house down the street, the house across the road, similar size, similar age, similar amenities, sold for whatever price is pretty much the price of your house gonna be valued. It's not gonna be too much higher or lower. It's pretty much gonna be tied to the comps. Whereas in commercial real estate, the value of the property is really determined by income. The market, the location, yes, there are factors, but at the end of the day, it's gonna be based on income. So we're going to do a little exercise so you can get a feel of why this is so powerful. So this is the 20 unit that the first multifamily property we owned, and it was sold. So we're gonna do an exercise, walk through this property. So at purchase, here's the business plan, right? We bought this property in 2020, I believe, early 2020. And the previous owner, they were an elderly couple. They had the property for 30 plus years. They really are hands off. They're not really doing much with it. And they're elderly. They just not really involved. They're not trying to do anything with it. The property is paid off, so they're not even pushing the rent. They're not doing any maintenance. They're not doing any improvements. So it's just there. So as you can see on the left side of the table, month one right here shows, this shows the rent collection in month one, which is very under market, because in Miami, for that location type of property, the market rent would be around $1,000. So like the 950 you see there is like the studio, and the 1100 is the one bedroom. This building only has studio and one bedroom. So the business plan was to renovate, right, to close on the property and renovate each unit. And as tenants move out, renovating them and make it nice and modern, and put new tenants in at market rent. So here's the business plan. And so as you can see, the number, the projection is at the end of the 12 months, we would be have a increase in income of almost $10,000 and over $100,000 a year. Now, what does that translate to in terms of property value? So let's see. Oh, let's go back. So here's the cap rate formula. It is a very simple math, and we're gonna do this exercise together. So we're gonna use the second one, which is the value, to calculate the value of the property, which is the net operation income divided by cap rate. Okay, so we're gonna plug in the numbers and see. So here's a really simple scenario, and I just want you to do the math so you can see why this is so powerful. So we're gonna assume the market cap rate is 5%. The cap rate thing gets really complicated, but in this exercise, we're just gonna assume, okay, it's a 5% cap rate market, and this building is generating $50,000 in income annually, right? So you're gonna calculate the value of the building. It's very simple. You divided the income divided by the cap rate. And then in the second scenario is like, say, if you own this building, you've been doing renovation, rehab, improvement, you're pushing the market rent, and now in year 2 or 3, you're able to collect $10,000 more a year. So you're at $60,000 annual income, per annual income, right? So, and then you're gonna calculate the value of the building the same way. So, all right, so I hope everybody get a chance to do the simple math. If you want to drop your number in chat, feel free. What did you get for the first one? The before, if your building generates $50,000 and you're in the 5 cap market. Okay, Sissy, thank you. So yes, 1 million, right? So you get $1 million, dollar for the value of the building. It's just a simple math. Okay, now do the same math, but with the $60,000 annual income. Okay, 1.2. Thank you, Linda. You are absolutely correct. So here's the thing, right? So if you are able to increase the income in any way, right? Either through rent increase, through improve your operation, by by cutting expenses, or there also, like, say you can build additional units if that's an option. So whatever you can do to push the income, it translates to a huge increase in value. So like right here is $10,000 income. It translates to $200,000 difference in the value of the building. And this is why the commercial real estate is so powerful when they compare to residential, because of the way it's valued. And so remember my little business plan here, what we have for this building, and this is the outcome. We purchased this building for 2.1 in December 2020, and we sold this building for 3.05 in September 2023. So this is the value creation of $950,000, nearly $1 million in 3 years. So this is the power of real estate, and this is why like we get excited with real estate, and it's such a exciting it's an exciting project. Whenever you're able to do a project like this, it's very, very rewarding. So of course, right? Like we want to give you a well-balanced view and pros and cons and picture, because everything is definitely not rosy all the time. And here are things you need to consider if you consider investing in real estate. Okay, first and foremost, real estate investing is an investment, and every investment comes with risk, right? So there is no guarantee. There's no guarantee you're going to make money. There is no guarantee, your project is going to be successful. We've seen plenty of people losing money in real estate. So I would say that is the most important thing to keep in mind. Real estate is capital intensive. What we mean by that is, unlike the stock market, right? You can buy something through Vanguard or Edward Jones. If you have $500, if you have $1,000, if you have $5,000. So you don't really have to have a lot of money to invest in stock market or other form of investment, but real estate is capital intensive. Even when we talk about 10, 20% down payment, sometimes that means thousands or tens of thousands or hundreds of thousands of dollars. It is not liquid. Your money is gonna be tied to the project until you sell the project, until you sell the property. So it is in there. You won't be able to sell it next day or next week. Usually it's going to take some time. And of course, it is a long-term strategy. It is not a get rich quickly scheme. Real estate really is for long term, and for somebody who's gonna really hold for a period of time, and that's when your property is going to perform. And of course, you have all the different external factors, right? Like Tiffany mentioned, you could have trouble tenants. I've had squatters. I've had people break into the house, frozen pipes, major capital intensive repairs such as roof, HVAC, things like that. So there are also a lot of external factors that you have to consider, as well as plan for it when you decide to buy a property. And we're gonna share the winning formula with you.
All right. Does anyone know who this guy is here? If he looks familiar, drop his name in the chat. Because this is the first step in the winning formula. Let's see. Warren Buffett. There we go. Yes, it is Warren Buffett. And the first thing that goes into the winning formula is to invest in yourself. The most important investment you can make is in yourself. So, ladies, please remember that throughout our investing careers, we've invested in ourselves by getting mentored and coached, and we're in masterminds. And that is an investment that has an infinite return on investment. So definitely invest in yourself. Now, this guy may look familiar as well. Does anyone know who this guy is? All right, Tim Robbins, close, close. Tony Robbins, there we go. Tony Robbins, yes. So the next thing is proximity is power. If you want to turn your goals into reality faster, then get yourself in proximity with people who are playing the game at a higher level than you do. I cannot echo this quote enough. It's really important to be in the rooms with the people that you want to be alike and who you want to be like one day. The proximity is power. If you get good partners and good people around you, they are going to organically pull you up. All right. And the last part of the winning formula, we have another quote from someone you may recognize. Anyone know who this guy is? If not, it's okay. There we go. Robert Kiyosaki, the velocity of money. So that is part 3 of the winning formula. If you want to be rich, you need to keep your money moving. The velocity of your money determines the size of your wealth. So just keeping the velocity of money moving. Remember, internal rate of return is important. You want to make sure it's moving and you get your initial investments back. And it's really performing at the highest and best use, to be honest with you. So the winning formula there.
So we want to thank you, Academy Women, for this opportunity to speak to your audience. We prepare a little gift for you. This is, so if you scan the QR code, it's going to take you to a page where you can download the Financial Freedom Calculator. Now, no matter what you do or what you're investing in, you can be, you know, serving the military, having a civilian job, own your business, whatever you do, this financial freedom calculator applies to everybody. Because understanding your finances and really know your numbers is the first step to get ahead. If you don't know where your money goes or what happened, they just disappear at the end of the month. Yeah, that's gonna be a problem. So this is a financial freedom calculator. You'll be able to download it. And there is an instructional video to go with it to show you the step by step on how to use it to plan out your 5 levels of wealth based on Tony Robbins' teaching when he talks about the different levels of wealth. We want you to have, we just think financial literacy and education is so important because it's not taught in school. So unless you seek out yourself, right, you're not gonna learn it through your HR, or military one source to a certain extent, I think, but at a very, very basic level. You're not gonna learn, this is not something you learn in school. Kids are not taught financial literacy in school for the most part. So people just, you see people who are really financial savvy, they seek out and they do their homework. So we hope you'll be able to take advantage of it and, plan out your budget and plan out your financial freedom map. And lastly, we want to stay in touch. Of course, we hope to build relationship with this group and connect with powerful women. That's what we are always passionate about. So if you scan the QR code here, it's gonna take you to my linking page and Tiffany's Instagram page, and you'll be able to find us there always. And that is our presentation.
Well, thank you both so much. That was incredibly well done. I felt like I understand the math behind just at a high level, as well as getting visuals of the properties you bought. I just feel like that is a great recipe for success in just first understanding what we need to know. When you first got started, did you set it up as an LLC?
Yes, my business was in, all of my properties were in my LLC's name.
Great. All right. And the QR code, we'll be sharing these slides afterwards, as well as we can probably put it into the email that we send out, or at least on the website. So if you didn't get that, then we'll be sharing that soon. Okay, great. Any other questions? Please go ahead and put them in the chat or in the Q&A feature. Okay. Great. Oh, how does capital work for these properties? Was a question. I'm not sure exactly which capital. Oh, does that make sense, that question? How does capital work for these properties from Linda?
Yeah. It's no different from, it's still real estate. So if you have capital gain, you will pay tax on capital gain. However, there are many ways to offset the tax, like we were talking about, because you can use depreciation from another property to offset it. But it is no different from residential in terms of taxation, but you just become creative with your tax strategy. Comes down to it.
Great. Irma asked, with increasing prices in real estate and interest rates, is it hard to find investing partners?
I'll let Tiffany answer that.
It's really deal dependent. We have seen over the past year, it's been a bit more difficult. We had a raise last December that we were able to finish out the raise in like 2 or 3 days, whereas, we had a closing in August where it took us quite a bit of time. So yes, we are finding it harder. But with interest rates starting to drop a little bit, we're hoping that, it'll turn things around a bit, but yes.
Another question from Linda. Have you done 1031 exchanges on any of your properties, or do you leverage that strategy?
So the 1031 exchange can be utilized, but we haven't used it on any of our properties. For the smaller stuff that we've sold, it hasn't made sense to actually do a 1031 exchange into a larger property. Normally when there's a 1031 into a syndication, it's normally, a few $100,000. So we haven't made that much money from our single families to actually, do a 1031 exchange into a syndication. But it's something that we open up 1031 exchanges to investors. So if you are a passive investor and you sell a property and you want to do a 1031 exchange, you can 1031 it into a syndication.
Fantastic.
I will also add, sometimes when you have a gain, and then, so like for that 20 units, right? We did have a gain, but the gain really wasn't like that significant because we were able to offset majority, like a big chunk of the gain with depreciation from another property. So, and for the remaining, it's like a little bit tax, right? Sometimes easier you just pay, because when you go into 1031, you're gonna turn 1031 to no end, right? I mean, unless you're just gonna pay the tax at some point. So it made more sense to offset it with depreciation and just pay the tax, the few $1,000s, and then that's it. It's a complete exit. No more things lingering out there.
Great. And final question is the financing strategy. Could you just talk a little bit about, do you use local banks, big banks? What are some tips that you use?
Do you want me to take that one?
Yeah.
So we typically use larger banks that are known to finance commercial real estate properties. So that's typically what we do. Depending on the property, depends on the strategy, meaning like some properties require a larger down payment than other properties. And that really depends on the stability of the property, and stability meaning like, what is the occupancy? Are the tenants paying on time? There's certain thresholds. So that really determines our financing strategy, but typically it's bigger banks that we deal with for the bigger properties.
Great. Well, thank you both. I just wanted to remind everybody that we can all stay connected with you through our virtual engagement center. And so please get on there and get involved, find people, groups that interest you. And this is something that is available 24/7. So take advantage of it. Don't forget, we're supporting the Service Academy Global Entrepreneur Summit that is happening October 15th to 17th. And there's some great opportunities for entrepreneurs there. Also, mark your calendars to join us. On 6 December, we have the Distinguished Speaker Series. That'll be held in Reston, Virginia, both live as well as virtual. So you have flexibility in how you can join us, and we'll be diving deep into AI and the future of work. Other future events are happening January and February. We have upcoming webinars, and then our big events out in Arlington, Virginia, our career coaching workshop, which is held in person, as well as our Officer Women Leadership Symposium, also known as the OWLS. Those will be happening the 2nd and 3rd of April, 2025. So plan to join us either virtually or in person, and we look forward to seeing you there. So take advantage of all that we have to build and strengthen our community with information, as well as incredible leaders such as Tiffany and Lupei. We look forward to seeing you at our next event. Thank you again so much, ladies, for sharing all of your insights and inviting everyone to just kind of get involved and be as successful as you.
Thank you, Susan. We really appreciate it. This is a great group of women. Like I already mentioned, we're just really honored to be able to meet your audience and share our story. And we hope to do more together.
Likewise, we feel honored as well. Have a
Thank
good day.
you.